Welcome back to YMT 220 Economics. We are still discussing Chapter 6, Supply, Demand, and Government Policies. We explained about the first part when we have controls on the prices, and we spoke about two main events when we have a price which is a floor or a seal which is binding or not binding. The effect when the price is binding, for example, the ceiling prices or price ceiling is binding, we have what we call shortage. So less suppliers are willing to sell or send to the market for selling or offer for their services for selling, and more buyers demanding the items or the services. And this shortage is a problem in the market. We spoke about its consequences, and also we spoke about the price floor, and we said also two situations. If the price is binding, and that means in that case what will happen is a surplus, more demand than supply, and in that case also it creates a problem, complication in the market. Think about the unemployment. So we discussed actually the evaluation of price control. So we spoke about these things, and we said actually the last slide in the previous video, we said about what governments should do. If they don't impose at all, there may be a problem. How about if they impose, there's also a problem. If they come up with any solution that doesn't exactly harm either of the parties, it's almost impossible, but these policies should be carefully revised, and maybe some subsidizing mechanism should be imposed. And if we subsidize, that means we need some money from where. So now let me say a few things before we proceed. Any government in the world has no resources by its own. There is no income for the government other than a few things that are available in the community, other taxes or the natural resources available in a country or so on. So basically, if we speak about the need for public schools, roads, hospitals, healthcare, defense, all these things, where does the money come from? Well, if natural resources are limited and they cannot sustain a whole country's economy, then there must be a taxing system. So the idea of tax is what? Imposing a percentage of the price of a good or a service on it. What does it mean? So instead of selling a good or a service by X price, we impose, or the government or governments impose, X percentage to be added to the unit. Now we will just simply we will speak about only tax per unit. We will not go to any other types of taxes. We don't want to get into a deeper discussion about tax. Let's just discuss the elementary part of taxing system and the effect of tax, and then we can further discussing tax and from other perspectives. So we speak about tax per unit, not any other tax. That means if you buy an item, let's say a phone, a smartphone, you buy it, they tell you the price is, let's say, 1,000 and plus VAT, value added tax, for example, let's say 10%, 20%, 15%, depending on the country, maybe less than that, maybe not at all in some countries, but for some countries that levy the tax, what happens? The percentage will be like maybe 10%, 5%, 7%, it depends. So it's a price per unit. In that case, it's the tax per unit in that case. Okay, so let's just take a very simple example, the market of pizza. Pizza is extremely popular and widely consumed food all over the globe. So if you think about the market of pizza, let's say without any tax, demand and supply somewhere, let's say with some certain specification of maybe large pizza or with some customization of topping or whatever. So 500 units or 500 pieces are demanded in that case. What happens? Now this is the equilibrium. Imagine for some reason a government is imposing tax on pizza. Now there are actually two ways to impose a tax. Now the tax is actually a certain percentage. Let's say 1.5, that's a certain percentage of the price. I'm not quite sure now how it is calculated in this case. It doesn't matter because we have to get the percentage, but let's say if it is 1%, it will be $1, for example. Now in that case 15%. And now what happens? We don't care about how it came, where it came from, and based on which calculation or the assumption of why 1.5, not 1.7, 1.8. It has its own calculation and it has its own background. We will not go through it, but just assume that there is 1.5 to be imposed on the price the pizza is sold at. Okay. Now there are two cases. Either the effect of imposing this tax will be on the buyers or on the sellers. Let's discuss both of them and see how it happens. Let's say we impose this 1.5 on buyers, the demand. So what will happen? If we are imposing 1.5, that means we have to shift this curve as much as the increment. So we have this increment, now 10, what will happen is we will have an increment actually of this by 1.5, but what will happen? So we're going to impose the tax on buyers. That means we have to shift the curve, this curve or this line in this case, by the price of the tax. So the price of the tax is 1.5. This one will be shifted to where? Shifted to the left, okay? And in that case, this is the tax. Now you may ask, why shifting to the left? Less buyers. When the price goes high, definitely we will have less buyers, and this is exactly the effect of the tax. So okay, we shift the demand, we have a new equilibrium here, and another intersection with the supply curve, so we shifted by the price of the tax. Okay, now let's address the outcome. What happens exactly? So the demand will fall for sure. Okay, the price sold by buyers will be higher. You look the intersection in this case. Okay, and the price received by the sellers will be less. Look, the intersection. Okay, now this is the price paid by the buyers, because we are still intersecting. Tax is like a new component. It's creating like a gap between the demand and supply. We are no longer having the equilibrium here. It's moved, but still we are not paying this amount because this is the new equilibrium, quantity versus price, but the price is added to it a tax. So this is the price to be received by supplier. Yes, at the equilibrium, true, but the price paid by the buyers is higher than that, is 1.5 higher, which is the tax. So if we ask any question about addressing the tax, like, let me get back so that I repeat in order for you to fully understand. Now, this is the plain demand and supply at the equilibrium with no any tax effect. If the price of the tax is imposed on buyers, then we will shift the demand curve by the amount of the tax. How do we know? It's easy. Now look, this is the tax. You shift this one the way it is along this line. Okay, this is the supply line. Just shift it down until this straight line intersects here and here by exactly its amount. How to do it? Usually, if we ask during the exam, we bring you some clearly actually stripped or pointed with all the numbers here, numbering scenario on the paper, so you don't have to worry about drawing this one out. So it will not be a problem. Now it's like a bit more vague. You cannot exactly guess, how do I know if it's intersecting here, what's the number? No, we will give you all these details. If there is any question, you will just need to mark up by your own using these dotted lines and things like that. Okay, so now we just shift the demand until it intersects with exactly this amount of tax with these 2 points, previous demand and the current demand, sorry, the new demand with the supply here. Okay, so now we have already added the value of the tax. Now what will happen? We have a new equilibrium. Okay, well, new equilibrium is contributing only to the price that's received by the sellers. Okay, that's it. And price paid by the buyers will have an additive tax or value added tax, for example, in this case. And that's what will happen. Exactly, this is what I said. Let me repeat. Look, the price paid by buyers, not only this one here, plus tax. Okay, their intersection with the supply plus tax. Okay, now initially the price paid by buyers and received by seller was 10. Now the price paid by buyers is 11, and price received by sellers is 9.5. And this is the problem. It's like exactly a wedge between the price received by the sellers and the price paid by the buyers. Okay, so now the other effect, previously the demand was 500, now the demand dropped. Why dropped? The main reason is people leaving the market. So we have some people are leaving the market here, demand shifted, some people are leaving. Plus another effect, some suppliers are not happy with the price that they receive. Because they receive less, that means there is also contribution from suppliers. They also, maybe they go out of business. Okay, so this is the idea. So in brief, what we call this effect, we call it the incidence of a tax. When the government imposes a tax or levies a tax, what happens? The burden of the tax is actually shared among the suppliers and the buyers. And no matter what, even if it is applied only to buyers, as you think here, we shifted only the demand curve, still there will be a percentage to be carried or to be paid by the suppliers. And this is what we call the incidence of a tax, the burden shared by all parties. All right. So again, to sum up, buyers pay $1 extra, for example, for the pizza. Sellers receive 50 cents less, and this is the effect of tax. All right. Now think about the tax on sellers. We don't shift the demand, rather we shift the supply curve, and let's see the effect. In that case, we need to shift the supply curve exactly by the amount of tax as we did earlier. So intersect the tax by its amount, move the supply, move it until the amount of tax intersects with the demand and the previous supply, S1. So in that case, what will happen? We will have a new price paid by the buyers and a new price received by the sellers. Now look, no matter what, if we shift the supply or the demand, the effect will be still there on both parties. The incidence of tax will be a burden to both parties. So price paid by buyers, 11, again, price received by sellers, 9.5, and we have the same scenario. You see tax received by the government. Okay. Now again, what will happen? We will have a fall in the total quantity. A lot of people will leave the market, either from buyers because they cannot afford or they are not willing to pay $1 extra for the pizza, or the sellers that cannot actually sell by 9.5 compared to 10. Okay, it's an assumption, but it may be true also, especially for wholesale. Okay, so in that case, the incidence of a tax is exactly like a wedge. A wedge is something separating the price paid by the buyers and the price received by the suppliers. Okay, so this wedge is actually has a bad effect, a negative effect on the market, and we will study this one thoroughly in another chapter. I mean, not now, but it has a negative effect. Now you may say, okay, why then, if it is bad to the market, why do governments impose it? It's a source of income. They cannot just run the whole economy of a country or of a nation without imposing tax. How will they pay for school, public schools, I mean state schools, building roads, factories, running hospitals, taking care of healthcare, police, defense, and so on? There must be a source of income, and this source of income is exactly tax, and that's why people are extremely careful about where the tax that they pay go to. So that's the exact idea in this case. All right, let's take a practical example and see how things go. Now, the previous example we took in the previous video, or the example we took in the previous video, it was about the market of hotel rooms. Now, hotel rooms, we had like 100 for the price, pick up the currency that you like, and 100 for the quantity. What happens? This is equilibrium without any tax. Imagine the government is imposing $30 per room. What will happen? So we will have to shift demand or supply, it doesn't matter. So 30, now look, 30, where it intersects with demand and supply, we can place it here. It's easy. From here to here, this is 30, 80 to 110, right? And then pick up, if you want to impose it on demand, shift the demand here, shift the demand to here. Or you want to impose it on suppliers, you shift it to here. Same effect. Ultimately, buyers and sellers will have to carry the burden of this tax in that case. So we impose the whole tax. It's like this percentage or this part, okay? And in that case, what will happen? Now look, this is the tax. So it intersects with 110, and that's the price paid by the buyers, okay? And it also intersects with 80, that's the price received by the sellers, and 30 plus 80, that's 110, which is the total price. 30 is the tax. Okay, so what happens to all rooms? Before we had 100 demanded, now 80 only will be demanded. And how about the supplied? So think about the supply. In this case, we have no problem actually with the supply, but rather suppliers actually will be not willing to supply. That's why we will have some shift in the market, okay? Like reduced amount of number of rooms. As I said earlier, the contribution actually comes from both supplier and buyers, not necessarily only from buyers, and it depends, and I'll explain about it in a few minutes later, okay? So the effect of the incidence. Now think about it. Earlier it was 100 and 100. So earlier suppliers were receiving 100, now they are receiving 80. So the burden to sellers is 20, okay? How about the burden to buyers? They were paying 100, now 110. Now the question is, why buyers are having less effect than sellers? Now this is the topic of the next actually subtopic that we have with this, the coming part. Now in the basic sense, now look at these two, supply and demand. Now look at the demand. It's actually more horizontal. It's like less inclined. Look at the supply, it's more inclined. Does it ring any bell? This one is less inclined, less inelastic. It's more elastic. Supply is more inclined, it's more inelastic or less elastic. And that is why the supply or suppliers, because they have inelastic or more inelastic supply than demand, they have to bear it more. Okay, this is the topic that I said we would speak about. The supply, actually, if the supply is more elastic than demand, the burden of the tax will be more or higher on buyers. Okay, now look, this one is almost vertical, and that's why it's more inelastic than the supply, and the bigger burden will be carried out or will be taken by the buyers. Sellers will have less burden. Even if this one is more inclined, sorry, is more like less inclined, is more to horizontal side, it would be lower and lower and lower. Okay, now this is a practical task for you. Think about it as a small homework, not real one. I create another real homework, but if you submit it, if you give the answer to me, if you provide the answer, I'll just think about giving you extra points. I want from you real life, okay, 3 examples about goods or services that have more elasticity for the supply over the demand. So the demand is more inelastic than the supply. Think about 3 other goods or services or mixed up among them. If you can come up with these 3, valid, of course, that they have, more inelastic demand than supply, so tax affects them more in the demand side, not the supply or compared to the supply. Think about them. If you can text me and I will take all your answers. If your answers are correct, I'll just consider adding you some bonus marks. Okay. So this is the burden of the tax for the sellers, less because it is more elastic. It's like going to the horizontal side more than the demand. Okay. All right. Now think about if the demand is more elastic than the supply. So if it is more elastic, it will be less affected, and the burden of the tax will be taken or carried by the suppliers. Now look at this, it's more going to the vertical side. This one is less inclined in this case. See, the burden of the tax is paid or taken most by the sellers, not the buyers. This is a smaller amount now, look, than this. So sellers will carry or will bear most of the tax burden or the tax incidence in this case. Okay. Now also, as I asked earlier, I need 3 from your life, 3 different examples, goods or services, where the elasticity of the demand is more than the supply, and the tax shared by suppliers, or the burden of the tax shared by suppliers, is actually higher than the share of the buyers. Think about it, combine it with this one, the one I asked here, okay, and send them to me. You can just use the text, the messaging section from your distance education part, and just send them to me in one file or in just one text. You just need to give 3 valid for each one of those. 3 more elastic demand than supply, 3 more elastic supply than demand from your own life, okay, about goods or services. Now, this is what I mentioned about. If the elasticity of the price for the buyers is higher than the elasticity of the supplier, then while the burden will be more on sellers other than buyers, and the vice versa, the other way around. If the price elasticity of the seller is greater than the price elasticity of the buyers, the opposite way around, as we explained. Now, one more thing, a case study. Now think about it. Since tax is actually a source of money for the government, any government in the world, why do not they levy it? Why do not they impose it on those who can pay it? How about luxurious things? Like think about yacht, think about private jets or airplanes, think about expensive cars, motorcycles, things like that. So if it is true, if they levy tax on those, who will be affected most? Let's think about it. Let's just think about it. The main aim is actually rising the revenue from those who can actually afford paying. While someone is buying a yacht, most definitely he can pay for some tax, but in reality, who is paying for it? Let's just check this real study. It was actually conducted in America about some private yachts, or actually for yachts. For the short run, what happens? The supply is very inelastic. Why? Because factories do not have, those producing yachts usually do not have any other job to do, it's just the production of yachts. So their supply is inelastic, they cannot give it up. Okay, there is a tax, we will bear it, we will earn less, but we cannot stop. Demand is more elastic. Well, people, if some of those who can afford yachts, if they feel like they are not satisfied with the price due to the tax, maybe they can go for something else other than yachts. Well, you have the money, you think about any other thing if you are not satisfied. So this is the idea. What happened is most of the tax burden was taken or carried out by the suppliers, not the buyers. The effect to buyers was actually much less than the effect on sellers. Now, when we have this effect on sellers, what happens? Selling less, maybe laying off employees, having troubles in different senses, other than actually receiving more tax to the government. And it came back with actually negative effects rather than positive effects in this case. Okay, this is just a case study. I may ask similar questions, and I may ask the consequence. Why do you think, like, if imposing tax on like expensive cars is not a very good idea, for example? Okay. All right. As a conclusion for the whole chapter, we actually have gone through different things. The first one is the price control, and we discussed their effect as a price floor and price ceiling. And we said that they are actually metrics, or they are forces that can be used to maintain the market, but they have to be carefully considered. So not just randomly imposed the way they are, because they may create like a very negative effect in the community. For example, the unemployment, which is really bad, terrible in many communities due to the price floor, for example, for the wage. The second thing we learn is actually the taxation system. When we tax a product or a service, what happens? So in that case, the burden of the tax will be, no matter what, will be carried or will be taken or will be actually paid by both parties, actually the buyers and the sellers. And in that case, it's actually a wedge between the buyers and the sellers. And for that purpose, tax by itself is a negative. It has a negative impact on the market, but it's a necessity. Countries cannot give it up, and in that case it has to be extremely or carefully applied. All right, these are actually the most, or the main common conclusions or summaries that we have from this chapter, and this is the end of the chapter. Until our next chapter, have a good time. Goodbye.